14 of 21 series are aligned with STAGFLATION mild this morning. That is a moderate level of systematic agreement across the engine's 21 series. The current macro regime is STAGFLATION mild, with a confirmation score of 14 out of 21. In regime terms, a STAGFLATION mild macro regime means the engine is observing growth momentum decelerating at -0.5615, while inflation momentum is marginally accelerating at +0.0081. The coherence score sits in a middle band, and the same 14 of 21 series confirmation score places today in what our framework classifies as a moderate confirmation environment. By our reading of comparable history, regimes with this level of confirmation in a STAGFLATION mild setup persisted in roughly 41% of cases over rolling 3-month windows, with the most frequently observed next state being an acceleration-style configuration. Compared to last week's readings, the confirmation score is unchanged, but growth and inflation momentum have continued to register in the same decelerating growth, gently accelerating inflation quadrant. Historically, environments like this have felt choppy across risk assets in our data sample, with more pronounced sector and factor dispersion and uneven bond performance rather than uniform directional trends. On the yield side, the rate complex sits in a relatively calm state. Treasury volatility via move is at 65.39, a normal reading in the high single-digit percentile versus the last 2 years, while the 30-year Treasury future is down about 0.7%, and the US dollar index is effectively flat. In our framework's reading of comparable periods, this roughly coincided with range-bound nominal yields and modest curve reshaping over the following 1 to 3 months, an observation under our methodology, not a forecast. Labor and activity proxies inside the engine, including PAYMs and jobless claims, ICSA components that currently carry red momentum tags, point to softening. A red momentum label in our framework denotes an unfavorable configuration, negative or deteriorating rate of change conditions, often with price or level readings leaning against prior trends. In our framework's reading of comparable periods, this roughly coincided with slower payroll growth and more frequent downside surprises in cyclical data over the subsequent quarter, an observation under our methodology, not a forecast. Credit and cross-asset risk indicators are shaped by geopolitics and inflation uncertainty. Spreads have been drifting wider, and the broader financial conditions backdrop remains influenced by a hold-for-longer Fed stance as policymakers weigh energy-driven inflation against softening activity. In our framework's reading of comparable periods, this roughly coincided with more defensive credit positioning and a higher incidence of spread-widening episodes within the ensuing 1 to 3 months, an observation under our methodology, not a forecast. On the equity and sector front, technology leadership is prominent again, with the sector up about 3%, while energy, financials, and healthcare trade lower, and utilities and industrials are modestly positive. Futures show a similar tilt, with Nasdaq significantly outperforming S&P and Dow benchmarks. In our framework's reading of comparable periods, this roughly coincided with continued factor and sector dispersion, particularly growth versus value in cyclicals, over the subsequent quarter, an observation under our methodology, not a forecast. Turning to the conditional map, the engine is tracking 2 explicit if-then triggers. If the 10-year yield crosses 4.45% and holds for 5 consecutive sessions. In our framework's reading, acceleration in the inflation composite appeared in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. Within a stagflation mild backdrop, that type of move has historically lined up with the acceleration-style transitions the engine flags in its regime statistics. If the fear and greed index drops below 15 and holds for 5 consecutive sessions, in our framework's reading, deterioration in the regime confirmation metrics appeared in roughly 7 of 9 comparable conditions. A historical characterization, not a forecast. In the context of the current 14 of 21 confirmation and fear level reading, that kind of shift would historically line up with more defensive cross-asset configurations in our sample. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated rules-based engine inside Given Analytics, It does two things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed four-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 symbols every trading day. When all four layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the four layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols. The four layers do. Members use Atlas to study how the framework has recorded conditions across prior environments. As historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. This setup is carries potential only as a research input, and is entirely educational in intent. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.